Welcome back to the Deep Dive. We're your go-to for, getting straight to the essential insights.
Cutting through the noise.
Exactly. And today, we're doing what we do best here at TalkTickers, unpacking a really interesting earnings call.
Yeah, this one definitely made some waves.
It did. We're diving into the fiscal year 2025 fourth quarter and full year results from a pretty major player in the AI infrastructure space.
These numbers dropped after market close on August 5th, 2025.
And the market reaction was, well, immediate. So our mission today is simple. Pull out the key takeaways for you.
Make sure you understand what's really driving things in this crucial sector.
Right. So we'll start with those headline numbers, the ones that caught everyone's attention right away.
Yep, break those down first. Then we'll get into the management strategy, their vision for the future, kind of peel back the layers there.
And wrap up by talking about what it all means, competition, outlook, the whole picture, giving you that context.
Exactly. So let's start with the numbers that caused the initial jitters. What were they?
Okay, so for Q4, the company reported GAAP EPS, that's earnings per share by standard rules, of 31 cents.
Which missed the consensus. Analysts were looking for 34 cents.
Right, and the non-GAAP EPS, which is often management's suggested view.
Yeah, sometimes gives a clearer picture of underlying performance.
That also came in light at 0.2041 cents below the $1.44 consensus, so about a 6.6% miss there.
And revenue, similar story.
Pretty much. $5.76 billion for the quarter. The street was hoping for $5.89 billion.
Okay, so a miss. But it's important context. That's still up 7.5% year over year. Growth is still happening.
True, growth is there, but the profitability side showed some strain. Gross margin for Q4 was 9.5%.
Down 70 basis points from last year. Not huge, but noticeable.
And adjusted EBITDA landed at $339 million, a 5.9% margin. So yeah, growth may be slowing a touch. Margin's definitely feeling some pressure.
But here's the interesting part, despite those Q4 misses.
Right, the full year picture.
The full fiscal year 2025 revenue hit $22 billion.
Which is huge. That's a 47% jump over fiscal 2024.
Massive growth. So even with the Q4 stumble, the underlying demand for AI gear seems, well, incredibly strong overall. It's just maybe getting reshaped a bit.
But the market reaction focused squarely on that Q4 miss and the near-term outlook.
Oh yeah, swift and pronounced. Shares dropped, what, 14% after hours?
14%. And options volume spiked like 7 times normal.
Wow.
Yeah, and with a really bearish skew. Investors were paying up for puts betting on the price falling further. So what was really driving that?
Okay, to get that, we need to look at, under the hood a bit at Q4 itself.
What were the key drivers?
Management said Q4 revenue growth was mainly driven by demand for their next-gen AI platforms, both air-cooled and liquid-cooled GPU systems.
The cutting-edge stuff.
Exactly. That made up something like over 70% of their Q4 revenue across both enterprise customers and the big cloud providers. So demand for the new stuff is strong.
But geographically, it wasn't even, was it? That part was fascinating.
No, not at all. U.S. revenues were actually down 33% year over year.
That's a big drop.
Huge. But then you look elsewhere. Asia surged 91%. Europe was up 66%.
Wow. So massive regional shifts happening. Maybe where the big new AI build-outs are focused.
Yeah.
Or hyperscalers changing buying patterns.
Could be. Management gave a couple of key reasons for the Q4 miss and why the Q1 outlook is a bit soft.
No, what did they say?
First, they mentioned some initial capital constraints earlier on, which limited how fast they could ramp up production.
Ah, okay. Growing pains?
Sort of, but they stressed those are resolved now, which they confirmed in their official 10K filing. So that hurdle is apparently cleared.
And the second reason?
Specification changes. For a major new customer, that pushed some revenue recognition out into the next couple of quarters, September and December.
Interesting. So working closely with a big client, maybe on custom stuff, caused a delay.
Seems like it. Hints that maybe custom solutions are becoming more important, but can also, introduce timing issues.
And they also mentioned a production learning curve, right, for these new complex platforms.
Yeah, basically saying it takes time to get efficient with brand new technology. Like you said, growing pains. Adapting to building the latest, greatest AI hardware isn't instant.
So the story they're telling is, yes, Q4 was soft, Q1 looks cautious, but it was due to specific identifiable things they're getting past. kinks, not fundamental problems.
Exactly. And that narrative flows right into their strategic vision, which is all about innovation and, importantly, diversification.
Still emphasizing their leadership in AI platforms, obviously.
Oh, yeah. Highlighting their portfolio being optimized for all the latest GPUs, NVIDIA's B300, GB300, AMD's MI350, MI355X. They made a point about being first or fastest to market with B200 systems.
And they expect the same edge for the B300 and GB300. That speed is critical in AI.
Absolutely. Being first can make a huge difference.
Okay, but the really big strategic shift seems to be this DCBBS thing, data center building block solutions.
Yes, this is key. It's not just a product. It's pitched as a whole new approach. Modular, comprehensive, designed to simplify building AI data centers and drastically cut down the time it takes.
What kind of time savings are we talking?
Pretty dramatic ones. They're saying liquid-cooled AI data centers could go from, say, 2-3 years down to 18 months.
Right.
Or converting existing facilities, maybe 12-18 months, down to just 3-6 months. If they can deliver that, it's a huge deal.
So what's included in these building blocks?
Things like direct liquid cooling systems, DLC2, they call it battery backup units, power shelves, cooling towers, basically everything you need, a one-stop shop.
Like Lego for data centers.
Kind of. The idea is moving from selling just the servers or components to offering the whole integrated solution, higher value.
And potentially higher margins, I assume?
That's the plan. They expect DCBBS could be like 20-30% or even more of total revenue by next summer. And yes, definitely aiming for better margins with it. It's a move up the value chain.
They're also growing their big customer base, right?
Yeah.
He's taking these large plug-and-play racks.
Yeah, went from 2 such customers in fiscal 24 to 4 in 25. And they're targeting 6 to 8 in fiscal 26. Ambitious growth.
And they specifically called out sovereign AI.
Right. Countries wanting their own AI infrastructure, Europe, Middle East, Asia, they see a big opportunity there. And apparently, those customers like the all-in-one DCBBS approach because it's faster and simpler.
Makes sense. Keep data local, build your own ecosystem.
And to support all this, they're diversifying manufacturing too, adding capacity in Malaysia and Taiwan.
Smart move. Less reliance on one region, helps with tariffs, flexibility for big orders.
Exactly. Building resilience into the supply chain, lessons learned from the past few years, probably.
And the diversification doesn't stop there. They're pivoting towards enterprise, IoT, and telco markets as well.
Yes, another key strategic pillar. The aim there is explicitly higher gross and net margins over the long run.
So investing in servers and storage for things like hybrid cloud edge computing.
Right, plus beefing up their enterprise support services. It's about moving beyond just selling raw compute power to hyperscalers and tapping into potentially stickier, more profitable segments. Tailored solutions.
Okay, so that's the strategy now. Let's get back to the guidance, because that seems to be where the market really balked.
Yeah, the Q1 fiscal 26 outlook, revenue guidance, $6.0 billion to $7.0 billion.
And the midpoint of that
is about 3% below what analysts were expecting, so a cautious start to the year on the top line.
And earnings?
Non-GAAP EPS expected between $0.40 and $0.52. The midpoint there is roughly 25% below the consensus.
Oof, that's a significant miss on the profit outlook for Q1.
Yeah, that definitely raised eyebrows. And they said gross margins would be similar to Q4 levels, so that pressure continues in the near term.
No wonder the market reacted negatively to that immediate guidance. But then they dropped that huge full-year number.
Exactly. Right after that cautious Q1 outlook, they guided for the full fiscal year 2026 sales of at least $33 billion.
Which is massive. And actually 10% above the current street consensus for the full year.
Right. It's a huge contrast. Short-term caution, long-term bullishness. They're basically saying, look past Q1, the full year is going to be big.
Supported by that growing customer base, new products, and especially this DCBBS strategy kicking in.
That's the narrative. Short-term pain, long-term gain. Asking investors to trust the vision.
And they reinforced that by talking about getting margins back up eventually, right?
Reiterated that long-term goal of getting gross margins back into the 15-17% range.
Through those higher value DCBBS solutions and the push into enterprise, IoT, and telco.
Exactly. Showing a path to better profitability, not just chasing revenue growth, quality over just quantity.
So let's connect the dots for our listeners. You've got this immediate 14% stock drop.
The spike in options trading, very bearish sentiment.
All focused on that weak Q1 guide and the margin pressure.
Sure.
But management is pointing to this $33 billion target for fiscal 26. It's a huge disconnect.
It really is a classic Wall Street puzzle. Focus on the here and now problems or buy into the long-term story. That's the tension.
So why the disconnect? What are the broader headwinds maybe contributing to the market's caution?
Well, look, AI spending is still strong overall, no doubt about that. But the industry is seeing more pricing competition, and component lead times are normalizing, which can also pressure margins. We saw that in the Q4 numbers.
Plus, competitors are stepping up. Dell, HPE winning some big AI rack deals recently.
Exactly. So the competitive landscape is heating up even as the market grows. That adds to the concern.
And how did the analysts react?
Mostly cautious. Some neutral ratings, trimmed price targets. You heard phrases like reality check or execution wobble.
Okay.
And reports that momentum funds were selling after the earnings. So short-term sentiment definitely shifted negative.
So it paints this picture. The AI demand is real, the top line growth is there, but
But there's execution strain, margin pressure, near-term hurdles. It creates this paradox.
and the company's big bet is that their unique approach speed, modularity with DCBBS, will win out against the scale of incumbents.
That's the bet. And investors want proof it works, especially on the profitability front. Eyes will be on their investor day in September for a clearer margin roadmap.
Other things to watch.
Volume shipments of NVIDIA's Blackwell systems later in fiscal 26. Any big sovereign cloud wins would be major validation too. Those are potential catalysts.
And the risks. What could derail the bull case?
Component pricing could slip further. They could lose more share if competitors' cooling solutions prove more attractive or cheaper. Basically, they need to execute consistently and show that margin expansion is real. Talk is cheap, right?
Right. They need to deliver quarter after quarter. Okay, let's pivot to our This Is Not Financial Advice segment.
Always preface this. Pure entertainment, conceptual discussion only. Investing is risky. You could lose money. Do your own homework.
Definitely. But given this situation, the sharp sell-off, but the ambitious long-term targets,
Yeah.
what's an outrageous but plausible idea?
Well, you could think about a barbell strategy here. It kind of plays both sides of that disconnect we talked about.
Okay, how would that work?
On one end, you make a long-term bet on the company hitting those big FY26 numbers and getting margins up with DCBBS and the enterprise push.
How would you structure that bet?
Maybe with something like long-dated out-of-the-money call options. Think FY27 LEAPs, for example. It's a levered bet that the big vision plays out over the next couple of years.
Okay, so that's the long-term bullish side of the barbell. What's the other end?
The other end hedges that and acknowledges the market's current nervousness. You could take a short-term bearish position.
Like buying puts.
Exactly. Buying some near-term put options to potentially profit if the stock sees more volatility or downward pressure because of that weak Q1 guide and the ongoing margin worries.
So you're trying to capture the potential long-term upside.
While protecting yourself or even profiting from the immediate uncertainty and market jitters, it embraces the paradox.
Interesting concept. Again, not advice, just an idea to illustrate the dynamics.
Precisely.
So wrapping this up, what really stands out from this whole earnings call and the reaction?
For me, it's the company's bold leap. This DCBBS strategy is a significant bet on changing how AI infrastructure gets built. They're ambitious.
But they're doing it while clearly navigating some near-term turbulence. Execution challenges, margin pressure.
Yeah, and that tension between the big vision and the current reality makes it a fascinating case study in market dynamics, innovation, and strategy in this incredibly fast-moving tech world.
Again, this isn't financial advice, just our analysis.
Yeah.
But the key question seems to be, how fast can they close that gap?
The gap between the impressive growth story and the markets need to see consistent, profitable execution, especially with their unique data center approach.
It's definitely one to watch closely. We'll certainly keep tracking it here at the Deep Dive.
Absolutely.
We hope this deep dive gave you a clear picture of what's going on. Thanks for tuning in.